We are joined by David Nelson, Belpointe Chief Strategist. He's joining us from Greenwich, Connecticut, frequent guest on the program. David, amongst all the other things to weigh there that I didn't mention is that we did get some economic data today as well, the various PMIs for market that showed readings of just under 50, which still signal contraction. So as you put all of this information together, I'm going to ask you the question that you asked in a recent note you put out, which is the rally, is the recovery at risk here as you weigh all of that?
Well, the economic data is encouraging, of course, and we've had an enormous rally and the price momentum is impressive. But in the end, it's all going to come back to the virus. I guess maybe my word of caution is we had that island reversal at the early part of the month. We still haven't taken out that gap. From a technical standpoint, that concerns me. But the bigger concern for me is kind of locally, and some of the anecdotal evidence that I have here, even in my own community, I look around and it seems like we're letting our guard down. I think everybody understands that America's going back to work and nobody wants the draconian measures. We're not going back there. Nobody has the appetite for it. The federal government, state and local government as well. But in the end, hospital capacity could likely dictate if in fact governors start to roll back some of this rollout. I look here in my own building and literally no one under 30 wears a mask, no one. And if I walk out on the boardwalk, I see a lot of people, and I don't mean just families who live together, I mean people who are just acquaintances, like the virus never even happened. So I feel we need to practice the minimum safeguards, and to a large extent that isn't happening.
David, good to see you. Next month, when we start getting second quarter earnings results, nobody expects it to be good, but sentiment being what it is, are investors who are buying today setting up for a fall because there's going to be reaction to the negative we're going to see next month?
I think it's more on the commentary, Adam. Like you said, nobody expects good numbers in there for this quarter. We're about to have a GDP print that's going to be a decline of 30%. To put that in context, global GDP in the Great Depression declined 15%. I think everybody's going to look at the commentary, and we're probably not going to get a lot right now. We're all crowded into this one side of the lifeboat, and that's the U.S. stock market, because there's nothing else. The Federal Reserve has murdered the fixed income market. Nobody has anything to offset their equity risk other than things like derivatives that are all tied to equity index notes. So one way or the other, we're piled into the stock market, and that's probably what's driving valuations higher.
David, Dan Roberts here. As you mentioned, what happens next is really going to depend on the virus. And in fact, I think a lot of the reason stocks have been up despite such ugly data for weeks now is just states reopening, even though now we're seeing maybe the negative effects of that, but optimism over the fact that, maybe an end is in sight, things are starting to reopen. So I wonder if the next big overhang for stock, either for plus or minus, would be the election. And it's funny because we have not talked about that for weeks. I mean, we talk about it here and there, but with so much focus on both the social justice protests and the virus, you could sort of be forgiven if you forgot that we have an election coming up. And I'm curious whether you think that one way or the other, that might have a big impact on stocks come October and November.
It's one of my big concerns. The election is, look, I don't care which side of the political aisle you live on. We understand that this election is going to be the most divisive in a generation. And as for some of the articles I even read on the Yahoo Finance site this morning, it's likely to translate. We're not going to even know that night. It could be literally days, if not weeks, before we know who is in the White House. That's going to cause some kind of disruption. Think back to 2000, when we had the contested election between George Bush and Al Gore. The markets were in turmoil at that point. We were obviously in a recession, but we have that kind of backdrop right now. We're in a recession. It'll create angst and uncertainty, and we all know that markets don't like that.
David, I'm curious about something much more specific that would impact financials, and it's 6 months to a year out. But there's that article in The Atlantic, Frank Partnoy was talking about, as we see defaults climbing in CLOs, there's also the potential for a magnified impact on the banks as commercial real estate defaults start to climb. Is this of any concern to you?
Commercial real estate for sure. I look around here, it's obviously going to be challenged because so much of commercial real estate is dependent on close proximity businesses. How many companies out there found that by putting their workers at home, they survived that? And now they're going back to work, and I can see right here in Stanford, some software companies have chosen not to renew their leases because it's working. Why pay that extra cost? And it has to translate into the financial community, because the financial community, my business, we're surviving very well with most of our workers working at home. It has to translate across the entire spectrum.
David, you mentioned that it's tough to find a place to hedge here because you're not getting any return in fixed income. If you're a retail investor, you're probably not going to mess with complicated derivatives. So what are you doing? And on the non-hedging side, is there anything that you're actually outright buying now, or are you feeling sort of too cautious to do so?
No, I'm pretty fully invested at this point. What I have done, and maybe the biggest change, because the economic data is getting better, is I'm moving down the valuation curve. We can't just hide out in secular growth stories anymore, because I look at some of these software names, even names like I own, like a Twilio, fabulous company and very needed, trades at 1,000 PE. These are valuations that go back to the dot-com bubble. So we're moving down the valuation curve, and I looked at things like financials. They're not going away. If the market has moved higher, then by definition, asset managers, their revenue has to move higher because they're paid just like I am, Julie. They're paid for assets under management. Some of these companies, like an Ameriprise, are trading at 9 times. That's pretty attractive to me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.